following paid commercial program is brought to you by TD Wealth.
Welcome to Money Talk. I'm Kim Parlee. There are concerns the U.S. banking industry could be facing another financial crisis after the collapse of Silicon Valley Bank. What does that mean more broadly for Fed, inflation, and the outlook for economy? Here to answer some of those questions, Beata Caranci, chief economist at TD. We'll let the banking analysts sort through the banking conversations, but I think that's the first thing is just how does this impact or does it impact the broader economy, the U.S. economy in the longer term? Let's start there.
Yeah, so what we're looking at is basically a confidence crisis, specifically related to the banking sector, but even more specific to those regional banks in particular. So from a Federal Reserve perspective, as they try to plan out or plot out the policy path, their number one priority is always towards financial stability. Otherwise, it's quite defeatist to raise interest rates when you have markets in turmoil. So the biggest economic impact is, aside from a bit of a confidence crisis within a segment of the market, is that it could sideline the Federal Reserve in terms of the degree to which they would like to increase interest. It may not stop them altogether, but it could throw off the timing in which they can move and the peak level they'd ultimately want to get to, which means you have to do a bit of a trade-off between the financial market stability and maybe more stubbornness or lingering of inflation than you'd otherwise like. Yeah, because as we speak, I think we've just learned this morning that the U.S. CPI came in, I think it was around 6%. I think that's a little bit higher at expected. So inflation's still there. Very much so, and when you look at those numbers, we're really focused now on the what's called the core services. The Fed has mentioned this, and they're taking out things like shelter costs, which we know are super, super sticky, but you could see that rent rates are coming in. So that will turn over time. So let's look at everything else and all those service costs that are related to the business cycle and the job market. Those are sticky. And so that tells us until that job market cools, it's going to be very difficult to get wages to cool, and that in turn makes it difficult to get prices to cool. So this is the transmission mechanism that they're looking at, and the inflation data we had today just confirmed that they have to walk and chew gum here at the same time in managing the financial risks on the banking side. But ultimately, they still have very much an inflation problem. I think that, also too, when you talk about the confidence too, I was looking at, I think, the Fed futures rates. I think it was, 4.84% before SVB, and then it bottomed down to 3.8. Now it's jumped up again. Yep. Like these, just for context, these are historic moves in what we're seeing right now. What is the impact of that, I think, on just how the economy functions? Because this is supposed to be the stable part where people kind of rely on these things, and that seems to be the issue. Yeah, a lot of bond volatility coming through, and it directly impacts what you're seeing in credit spreads. So if you look at your lower investment grade spreads, triple Cs, Bs, you saw those spreads widen out to over 100 basis points just on these moves. So the treasuries are dropping at the same time they're getting pressured up because they carry that higher risk element to them. So there is a direct impact that starts to feed through. I think in these type of situations, though, most businesses would go into a let's wait and see mode. So they're not going to throw out those investment plans and start over. It's more let's see how the dust settles. But it definitely signals that there's more caution ahead. It definitely gives you pause that it's not really just about the level of interest rates and lowering inflation. Now you have to think about specific interest rate sensitivity within segments of the market, and it shows the complexity of it. And that can certainly make businesses more cautious as they go forward, as opposed to just the event itself. A lot of people watching what the Fed's going to be doing, of course, next week, and so we should talk about that. Does this change? It does. The market's already priced in the changes. What are you expecting to have happen? Yeah, we left our quarter point hike in for next week. Markets were leaning towards 50 basis points prior to this. That's pretty much priced out of the markets completely. It was fully priced out, meaning the markets were leaning towards no rate hike at all. After today's inflation data, you saw that pricing creep back in that, well, actually, there's still a good case here to have these smaller incremental moves from the Federal Reserve. So we've left our 25 basis points in. However, what we're telling people is it really comes down to where you are on the day of or the day before the meeting. If you have a financial storm kicking in, they will not be raising interest rates. They could do something similar to the Bank of Canada, pause, observe, and then move back in on the policy side once the market calms down. If we're in a relatively calm waters in terms of financial market volatility in the banking sector, then they certainly have more than enough economic reason to raise interest rates.
All right, stay with us. When we come back, we're going to be delving into what this could mean for the Canadian economic situation. You are watching Money Talk.